Welcome. As part of our Traders Classroom subscription, you not only get 3 new hands-on video lessons in Elliott Waves and other technical analysis tools every week, you also get to have access to monthly live webinars where our instructor dives deep into a specific topic. In this lesson you're about to watch, our former TC instructor Jeffery shows you how to identify the critical elements of a proper trade setup, why understanding the risk-reward relationship is so important, when to pull the trigger, objectively, and when to jump ship. If you want to learn more about how to utilize and use Elliott Waves in your trading or investing, take a look at the additional resources we recommend under this video. Enjoy.
How to formulate a trade plan, knowing what a trade looks like, and being able to, really pull the trigger and do so confidently. So we're going to talk about a little bit about identifying the critical elements of a trade setup, understanding the importance of risk reward, because there's a lot of stuff out there that's just not worth my time or attention. Okay, and then ultimately pulling the trigger. Now, I'm going to be using some slides and some charts that I've spoken about before in Traders Classroom. Okay, for example, this one, Bloom Energy Corporation. We were talking about Bloom Energy Corporation. This was Tuesday, September 29th. From what I can see on my chart here, let me get my reading glasses. Small print, about 1688. Okay, so very short term, we were right about here, and the analysis was pretty much what you see in this chart. Okay, so we were looking at 1 up, 2 down, 3 up, triangle 4, and we were looking for the pop up to 2274. That's the analysis. Okay, that was the wave count. Okay, my style of trading is very elementary. I like to find a trending market. As you can see, from the March low, the market's just moving up. The trend is up. So that being the case, I look for counter trend price moves to position myself in the direction of the larger trend. It's a very simple approach. I'm very much of a trend trader, and the reason why is because it works. Okay, trying to pick tops and bottoms, trying to nail the bottom and nail the top. Can you do it? Yes. Is it possible? Yes. Have I done it? Yes. Have you done it? I have no doubt you've done it, and you've probably done it more than once. But you know as well as I do that that is a very tough game to play day in, day out, week in, week out, month in, month out, year after year after year. So I like things simple. Okay, so I want to go back and just walk through these charts and show you, number one, the analysis, how and why I define this as a high confidence trade setup, and then we're going to look at some of the more specifics like evaluating risk reward. Because if a trade doesn't offer a better than 1 to 3 risk reward, meaning if I'm risking $1, I want to make 3. And if I can't, then I'm just going to pass on the trade. Okay? Just going to leave it alone. It's not worth my time. It's not worth my time. It's not worth my attention. It's not worth me risking my money. Okay? And then we're going to talk about actually pulling the trigger on the trade. So this was the analysis. 1, 2, 3, triangle 4, 5. Looks like a good story. Do we stop there? No. We want to see some other stuff. Okay? We want to build a case. Okay? I'm all about building a case. I'm all about looking at other forms of technical analysis to support my assessment. Okay? So if we go back in time there, and that would have been right about there, I think, price-wise. Okay, you can see, we talked about this earlier this week, how RSI is coming into that RSI bull market support. Okay, so basically this is telling me that this is, all pretty much counter trend price action in the direction of the larger trend. And then, of course, if you're familiar with KCT, you know that the trend lines are appropriate for waves 1, 2, 3, triangle 4, 5. Then now let's look at some candlestick work here. Okay, what we have here, this is what is that? That would be the 29th, I think. Yeah, 28th, 29th. It was on a Tuesday when I showed the chart. Yeah. Well, no, it actually, the chart says 28th for whatever reason. Oh, I must have done this pre-market. Okay. So we're looking at the market really, this day right here. And you can kind of see we have a little bit almost of a morning star formation. I think the analysis, whether it's a candlestick interpretation or momentum work here that we see, or KCT, or the wave principle, that we can actually make a compelling case, or at least buy into the idea that this issue is going to continue higher, and essentially we're going to be looking for a move up to that target of 2274. Okay, so now let's move down to the intraday. Okay, here's the intraday chart. Okay, and we're looking for a move up to 2274. Okay, so let's put that line on the chart. Okay, and let's go back in time. So that would have been right about here, okay, right where that dashed line is. Okay, 28th. Yeah, that's about right. Okay, well, first off, let's just say we're looking at the market here at 1643. Is this trade worth even taking a shot at? Because remember, the larger pattern is that of a contracting triangle. What do triangles do? Triangles tell us that there's going to be one more move in the sequence, and then it's all done. Okay, that's what a triangle, that's one of the meaningful aspects of a contracting triangle, is it always precedes the final wave of a sequence, which is why a triangle may only occur by itself in the 4, B, or X wave positions. It's basically the market's way of saying, hey, the party's almost over here. So once we get the pop, we're probably done. We're going to see a top, and then we're going to see a reversal in price. Okay, so we're trading 1643. Let's see if I buy the market at 1643, where's my stop going to go? It's going to probably go at where I'm identifying that fourth wave move. So really what I want to try and do is kind of get an idea of the risk-reward ratio. So my risk is 1405. Okay, so if I get in at 1643, there's my risk. Okay, so I need at least, 3 of these blocks to the upside to actually warrant having a trade. And we're barely there, okay? So I may actually want to wait on this, okay? Because at this point at 1643, it's not an exact 3-to-1 risk-reward ratio. All it's basically saying is, hey, we're going to pop above this extreme here at minimum 1967. So why don't we wait, okay? Because if you look at the smaller structure here evolving in BE, you can see a small little up, down sequence, a little bit of an acceleration gap. Okay, maybe this is like 5 of 1. Okay, well, if that's the case, then we need to see a pullback. Okay, so 1, 2, 3, 4, 5, 6, 7, 8, 9. Maybe we come back down into this area here, say 16.5, and then look for that decline and then maybe a reversal. So we'll treat that as wave 1 of 5 and maybe look to buy a pullback. And then we come down. Okay, well, there's a good entry right there. Well, again, but there's no confirming price action that sell-off is complete until that day. Now this is a much more attractive scenario because now we can actually buy the market at 1770. Here's pretty much our risk, the low right there. And now if we do that, you can see that we do have, I think, a better risk-reward ratio on the trade. So one thing that's very important whenever you're trying to identify a trade setup and feel comfortable pulling the trigger, I want to see something on the price chart that supports my assessment. I'm looking for that confirming price action. I don't like to guess. I want to make sure that I've got at least a 1-to-3 risk-reward ratio on the trade setup. So going back to the example that we have in front of us, if we buy the market over here, then our initial protective stop has got to be this low. Okay, if we wait, if we're patient and look for the pullback and then something to the upside, and if you're watching this intraday, maybe you even get a nicer entry, then essentially that low is going to be our protective stop. When you trade, and take this to heart, write this down, when you trade, you're going to be wrong. If you trade, you can and will lose money, okay? You can't avoid it. But what you can do is that when you're wrong, that the losses are very small, okay? That's the best thing that you can do. Focus on managing risk. And whenever I say managing risk, that's exactly what I mean. Keep your losses small. There's no need to buy, Bloom Energy at 16 and run a stop at 12, or buy Bloom Energy at 16, let the market come down to 12 or 11, and then send me an email going, Jeff, I thought you were bullish on Bloom Energy. I'm still holding from 16. What should I do? Well, you shouldn't be trading if that's what actually happened. But as you can see, the market went up. We tagged our level, okay, probably waves 1, 2, 3, maybe a 4 here, up in 5, and now we're coming back down. So, again, the market followed, I think, quite nicely its Elliott Wave script. Okay, we were looking for a move up to 2274. The move up out of the up to 2274 was indeed going to be a triangle thrust. We got the triangle thrust. Now the market is going to be in corrective mode for a period of time and probably make it all the way back down to 12 or 10. Okay, so going back to this idea here, was this an acceptable trade? Was this a trade worth taking? Well, arguably, yes and no. You don't have like a 1-to-4 risk-reward ratio. You barely have 1-to-3. So if you wanted to pass on this, I certainly would not have a problem. I think to refine it to where you did have a legitimate straight-up 1-to-3 risk-reward ratio, you would probably have to move down to the smaller term time frames and really watch this short-term structure. Like, for example, maybe buying in this area right here with about a $1 risk, and then you're looking for about $2 or $3 to the upside. That would have worked. Okay, also, too, this was just a pop and drop, okay? So you don't want to be up here, looking for a move up to 23, get to 23 and get greedy, thinking, okay, we made it to 23, let's go to 26. Don't do that, because that wasn't the game plan. The game plan was to get a pop to 2274. We got the pop to 2274, okay? And also, too, the move to the upside completed a 5-way structure as well. 1, 2, 3, 4, and 5, okay? Now we're unfolding in 5 waves. What's going to happen next? Well, it should be clear. We're going to see, once we finish 5 down for A, then we're going to go up in B. So my next opportunity to sell Bloom Energy is going to be following a 3-wave move here. Does everybody follow so far? Again, it's kind of like a step-by-step process. First, do we have a trade? Yes, we have a trade. Is that trading idea or assessment supported by additional information? Do I have more than one witness to the car accident? Okay, fine. Yes, I do. Okay, and then does the math work? Okay, does the math make sense? And the reason, a question. Well, Jeff, why is it 1-to-3? Because if I wait for 1-to-3 risk-reward ratios, I'm really not going to be trading that much because those types of proportions just don't occur all that frequently. Okay, fine. I actually don't see that as a problem because that has 2 benefits. The trades you take are going to have a higher probability of working out, and also, 2, you're going to trade less. Overtrading is, if you're losing money as a trader, I would probably say odds favor that you're doing a couple of things. You're trying to pick tops and bottoms, or you're over trading. That's why you're sucking. Okay, that's why you're not seeing the performance that you want to see. Stop over trading and stop trying to pick tops and bottoms. What you'll do is you'll trade less, and then the trades that you do take are going to have a higher probability of actually working out. Okay? So just keep it simple. Again, there's always going to be another trade. Don't worry about missing the big move up in Tesla because there's always going to be another big move in Tesla, or there's always going to be another big move in like a line, or there's always going to be a move somewhere. So stop trying to chase opportunity, because if you stop moving, stop chasing, stop running around afraid you're going to be missing opportunity. If you just stand still for a moment, you'll realize that you are surrounded by opportunity and that you have choices all over the place. There are more opportunities to trade and make money in the financial markets than you have money to trade. And I don't care if you have $100 million in your account. Trust me, I can spend it, okay? There's that many opportunities. Okay, now let's move on and take a look at a few other markets because I'm kind of getting a bit long-winded, which I have a tendency to do, and I apologize for that. We're going to look at another one, Qualcomm. Okay, we talked about Qualcomm on October 1st, and here was the lesson. Here was why we were looking up in Qualcomm. Acceleration gap that identified that peak as a wave 3. We saw 3 waves down, counter trend move. This was a no-brainer. This was a gimme, okay? It's, again, acceleration gap. Acceleration gaps occur most frequently in the wave 3 position of an impulse wave. 3-wave decline right into our KCT support lines for 4th wave support. This was kind of a no-brainer. This is the kind of trade again, the hardest thing about being well, my father used to tell me this, and I've shared this with you before. The hardest thing about doing a good job is that you have to do it every day. The hardest part about trading well is that you have to trade well every day. So you have to not overtrade every day. You have to not try and pick tops and bottoms every day. And it's real easy to slip back into bad habits and try and pick tops and bottoms. But here's the logic. The trend is up, 3 waves down. We've got what we need. Here's the that momentum pattern that we talked about earlier this week. RSI is clearly within RSI bull market support. You got a nice approaching near oversold in our stochastic. I'm loving that. Okay, then we come over to our candlesticks here. This was the date of the move, I believe, where we were looking higher. That's fine. Oh, nice readings here in the 5-period %R. Looks good, okay? So let's go back here, intraday, and figure out when would be the time to pull the trigger. Now, if you're looking for an absolute, okay, is there a single best way to enter a trade? Like, when did you get in? Well, I didn't take the trade, number one. But I just want to go ahead and answer this all elusive question, or this question I get all the time. What's the best way to enter a trade? There isn't one. It's whatever works best for you. You can base your trigger pulling decision on several different factors. Okay, let's pretend for a moment. Okay, we're looking up to 130. Let's evaluate next if the trade is even worth taking. Okay, well, we have the up-down sequence. We have the break of the upper boundary line of some very small base channels working here. So we've got confirmation of 3rd wave price action. So if we buy at 1849, we'll just call that 118.50. We're probably going to see some kind of pullback or correction, maybe back down to 16 for a 4th wave. So I think an appropriate stop would probably be right here, a little bit below that wave 1 extreme. That comes into play about, say, 113. We'll call that 113.50. So I'm risking, what, $5? That's risk per contract or per share price. Okay, well, if I'm going to risk $5 on this trade, then I want to see at least a $15 price move. So what's 118? Let me see, 118 plus 15 equals, that pushes me up to 133. Again, we're not getting that real sweet, 1 to 3 risk reward ratio. Maybe what we need to do is wait. Okay, which brings up another good point. Stop rushing. That mindset that you got, that I got to get in today at 9:32, 2 minutes right after the open, because if I don't, I'm going to miss the opportunity. Dude, if you're thinking that, and I mean, dude, as far as, and dudettes, okay, men as well as the ladies, because I know I have a bunch of ladies in the room, stop being in a rush. Because being in a rush is nothing but fear in action. Because if you're in a rush, that means you're afraid of missing out. And if you're afraid of missing out, that means you embrace this idea subconsciously of lack. Okay? Well, if that's what you believe, that's exactly what you're going to get, people. Okay? Stop being in a rush. Hey, if this trade doesn't work out, guess what? I got a dozen more. Okay, but let's watch it. So really, this is a viable setup. I like the daily trend is up. I like the supporting stuff we see on our RSI and candlesticks. I got 3 down. I got confirmation of a wave 3 price action. So really what's holding me back from buying 118 is the math. Okay? So if I can maybe buy 116 with a stop at 114 or 113, I've dropped my risk from $5 a share down to $3 a share. That's much more acceptable. So let's see what happens here. Okay, there we go, 116.50. Okay, I'm willing to buy 116.50 with a stop at 113.50. I got a $3 risk. So now I got to just do 369 to the upside. Now we're looking at a profitable trade. I have no problem buying 116.50 against, say, 113.50. And as you can see, everything worked out. Okay, now we have a little bit of a gap up where we've hit our initial target. Guess what, people? I'm gone. I'm done. I've made my money, okay? Because at this point, you're probably looking at 1, 2, 1, 2, 3. But remember, the objective to trading is to make money. Well, you can only do that if you make the cash register ring. I'm not looking to buy bottom tick and sell top tick. I'm looking to capture 80% of the move. Okay, in this instance right there, after that pop to the gap up, I'm done. I'm done. I've made my money. I'm gone. I'm looking for the next trade. How many times, and I can't tell you how, it took me, so many years to learn this lesson. How many of you have done this? Okay, I take a trade, I trade options, okay, and then next thing you know, I'm up 50% on the position in a matter of like 2 or 3 days, okay, and then we see this little pullback. The next day, that option position is now only worth 20%, and then the following day, okay, now I'm underwater, 30%. Oh, but it's going to come back because I know it's a 2. And then the following day, now the option position is pretty much 90% under the water. Okay, why didn't I take my money when I was up 50%? Greed, okay? You can't lose if you continue to take profits. Remember, small, consistent profits. How many of you, well, again, this goes back to a lesson I learned a long time ago. And it's basically my baseball story. Again, back in the day when I was really getting started, and that, being an analyst and also being a trader, man, I thought extremely highly of myself. The older I get, the more I can laugh at myself, and man, what a joke. Okay, but I can remember there was, I was looking at my trade log, and I had about like 30, 60 days of a trade log where, I had everything, the entry price, the exit price, open equity, max drawdown, the whole thing that you're supposed to do. I don't go through that exercise anymore because it's primarily time consuming. But I'm sitting there and I'm thinking, man, you are just a brilliant analyst. You really are. And you're right, the market, 80% of the time. But when we look at my trading results, when I actually look at really what matters, is the number at the end of the month green or red? That's the only thing that really matters. Everything else is just noise that we all get too easily distracted by. And I'm like, man, guess what? My analysis is 80% correct, but what the hell's going on? Because 80% of my trades are losers, okay? What's going on? What's the problem, okay? So I started to track, and this took me, 2-3 weeks painstaking work, 8, 10, 12 hours in front of my computer, walking back through on 5-minute price charts because I was day trading at the time. And then I began to realize something. Of the 80% trades that I was losing money on, guess what? 80% of those trades at one point or another were profitable. The problem was I was not taking the money off the table when it was there. So I was as good as I thought. I just wasn't taking the money, because if I made $1,000 on a trade, what was I looking for? Oh, I was looking to make 2. And if I got to 2, I was looking to make 3. Okay? So at this point here, what I've finally learned, and it took a long time and a lot of money, is I have no desire to buy bottom tick. I have no desire to sell top tick. I'm just looking for them to make the cash register rate. Period. That's it. Okay, I've got one more example, and then I'll start answering your questions. We're going to take a look at First Solar. We were talking about First Solar on September 30th. Okay, and this is what we were looking at. 1, 2, 1, 2, 3, called that a 4, 3-wave decline. Previous 4th, trend lines are working. So that worked out. That looked good. This was nice here. I like the pullback, a little bit deep as far as the move below RSI bull market support, but it was not sustainable, and you certainly had an oversold stochastic. This is exactly what we were talking about earlier this week. And then the candlesticks, they look fairly good as well during that period of time as far as moving up. I definitely like what we're seeing here as far as the values of our 5-period %R. So I can definitely make the case that, hey, this was indeed a buying opportunity in First Solar back here in late September, early October. Okay, so now we go down to the short-term price chart. Now the target here is essentially 90.41. Okay, and we were talking about buying, looking at the upside in First Solar at 9:30. Okay, so again, what do we need to do? We're trading what, 66? Okay, so we're trading $66 a share. I'm looking for a move up to, we'll just call that 90. Okay, where if I buy the market, where am I wrong? Well, if we buy the market, I really would not want to see prices fall below, say, that 62 level. Another thing you've heard me talk about time and time again in Traders Classroom, when I first started trading, probably the first 5 years actively, and I'm talking like, a couple hundred trades executed per year, I would always, sit there and go, okay, if I'm right, I'm going to make this much money. If I'm right, I'm going to make this much money. Dude, and dudettes, I stopped doing that. I don't do that anymore. The first calculation I do now is, okay, if I'm going to be wrong, how much money am I going to lose, and is that amount acceptable? And if I do, like, say, 5 or 6 of those losses in a row, am I bleeding out, or is this just kind of like a minor discomfort in a bigger picture? Because you can lose the battle and win the war. Okay, so we're looking to buy 66 against 62. Okay, from 66, if we do get our move up to 90, okay, hey, that's a very nice risk-reward ratio. This is the kind of trade that I really like waiting for and want to see. So I'm more than happy to buy this one here with a stop at 62. Okay, prices are moving up, prices are moving up. Okay, now if we're trading 78, is my stop at 62? No. If we're trading 78, after seeing this kind of a pop here, honestly, between you and me, and don't tell anybody, I'm probably already gone, because that's a nice $10 price move. And if you're familiar with options trading, that's a nice return. So at 66, if we were trading 66 and you bought 70, say, November, December calls, and then this puppy pops up to $80 a share, you're looking at a couple of 100% return. I'm going to take my money and run like a thief. I'm gone. I don't care about going all the way up to there, because, again, I've done my job. My job is to make the cash register ring. My job is not to buy bottom tick and sell top tick. My job is to capture 80% of a move. Okay, so by letting the first, say, 10% go, and then the last 10% go, or maybe even 20, What you're doing is you're allowing the market to, the way I phrase it is, I want the market to commit to me before I commit to the market, okay? So the longer I wait, yes, that will decrease the potential earnings on a trade. But what it does do is it increases the likelihood of a successful outcome. Okay, so that's about it for my presentation. I hope that makes sense.
Thank you for watching. Jeffrey Kennedy was certainly a great teacher with vast knowledge. We still have many of his courses and resources available in our store for you to purchase and explore if that is something you want to do. Our new Traders Classroom instructor, Robert Kelly, has over 25 years of experience in the markets and shares his time-tested tools and tips to his subscribers 3 times a week. If you're interested in continuing your Elliott Wave education, this would be a great place to start. To learn more about Traders Classroom, just click the links below this video. I'm Greg Iden with Elliott Wave International. Until next time, have fun riding those waves.